Okay, let's try and unpack this. We often hear about government spending, these huge numbers, trillions of public funds, and it's spread across this massive network of national departments, provincial bodies, commissions, councils. It's vast.
Really is.
But here's the big question, right? How does a state, something this huge, actually make sure that this whole machine runs with some kind of order, accountability, and maybe most importantly, transparency?
That really is the core puzzle in public finance. And the main answer, the foundational law that governs basically every cent is the Public Finance Management Act, the PFMA.
Right, the PFMA.
It was first passed back in 1999, but we're looking at the consolidated version now.
Right.
It's been amended pretty frequently, which makes sense right up to, well, what we see effective today in 2025.
Yeah.
It's definitely a living document.
So our mission today, for you listening, is to really boil this big act down. We want to get to the core requirements, what it means in practice, and maybe some of the surprising details that keep this system ticking over. What's the PFMA actually trying to do at its heart?
Well, its stated object right there in Section 2 is pretty clear. It's about securing transparency, accountability, and sound management.
Okay.
And that applies to all revenue, all expenditure, assets, liabilities, basically everything financial across both national and provincial government. It's the definitive rule book.
And it's not just for the big national ministries in Pretoria, right? This net is cast much wider.
Oh, absolutely. The scope, as laid out in Section 3, is enormous. It hits every single government department, sure, but also all those constitutional institutions.
Like the IEC, the Human Rights Commission.
Exactly. Those kinds of independent bodies. And then, crucially, this huge list of public entities in Schedules 2 and 3.
So household names, really. We're talking Eskom, SARS.
Precisely.
Yep.
If it's a public entity handling public funds, whether it's a state-owned enterprise or a smaller board, the PFMA applies. It's comprehensive.
Okay, let's start with the structure then. Who actually holds the reins? Who controls the money? You mentioned treasuries.
Yes, that's central. You've got the National Treasury, headed by the Minister of Finance, and then parallel provincial treasuries, led by the provincial MECs for finance.
And the National Treasury does more than just, count the beans.
Much more. Section 6 outlines its functions. It promotes national fiscal policy, coordinates financial dealings between different government levels, manages the whole budget process, and this is key, monitors and enforces compliance across the board.
Enforcement, that's the word that jumps out. It sounds good on paper, monitoring compliance, but do these rules actually have teeth? How strong is that enforcement power?
This is where the Act gets really interesting and, frankly, quite powerful. Section 6.2 says the National Treasury isn't just suggesting things, it must intervene if there's a serious or persistent material breach of the Act.
Must intervene.
Yes, by a province or a public entity. And that intervention toolkit includes the very real possibility of withholding funds that have already been allocated.
Whoa, hold on. Withholding funds. That sounds like the ultimate financial weapon. What does that actually mean in practice? Could they, stop paying salaries in a provincial department?
Well, the idea is to be targeted, but yes, the impact can be immediate and quite severe. If a province is consistently messing up, maybe failing to report properly, or significant unauthorized spending keeps happening, National Treasury has the constitutional power to slow down or even stop the transfer of funds for specific programs. The aim isn't to cripple essential services, ideally, but to force that provincial treasury or entity back into line. It really escalates the pressure. It moves beyond just advice.
That makes the control feel very real.
Okay, let's talk about the money flow itself, these revenue funds. The idea is simple. All money goes in, and getting it out is tough.
That's the fundamental safeguard. Section 11 for national, Section 21 for provincial. Every rand received by government has to go into the correct revenue fund, period. It stops money disappearing into side accounts or being spent off budget.
And getting it out, highly restricted. Withdrawals can only happen in basically two ways. Either through an appropriation act, meaning Parliament, or the provincial legislature specifically approves the spending, or if it's a direct charge already set out in law, like judges' salaries, for instance.
But what about, life happens, crises occur, floods, infrastructure failures, things you couldn't possibly budget for perfectly. Is there any flexibility for genuine emergencies?
Yes, the PFMA isn't totally rigid. Sections 16 and 25 deal with this. The Minister of Finance, or the provincial MEC, can authorize emergency spending if delaying it would cause serious harm to the public.
Okay, so there's an escape hatch.
But it's a very small one and very tightly controlled. There's a really memorable cap. The total emergency spending authorized in 1 year cannot exceed 2% of that year's total budget.
2%? That's tiny, relatively speaking. Ensures it's only for real emergencies.
Exactly. And there's an immediate transparency check, too.
Yeah.
Any emergency spending has to be reported to the relevant legislature and the Auditor General within 14 days.
14 days? Wow.
Yeah, it's a very short leash. Keeps it visible.
Okay, so Treasury controls the structure, the money flow is tight. But who are the actual people on the ground responsible for managing all this day-to-day? Let's talk about accounting officers, the AOs.
Right. AOs are absolutely crucial. This is usually the Director General of a department or the CEO of one of those constitutional institutions we mentioned. They are effectively the chief financial steward for that entity.
And their job description is?
Section 38 lays it out. It's pretty demanding. They have to establish and maintain systems for financial management, risk management, internal controls, and procurement. And these systems need to be effective, efficient, and transparent.
That sounds honestly like trying to bolt corporate governance principles onto government departments. What are their really practical, non-negotiable duties?
Well, things like making sure all money owed to the state gets collected, safeguarding all state assets, buildings, cars, equipment, you name it, and ensuring all the department's bills get paid on time. But probably the most critical rule, the one that bites, is in Section 382. An AO is strictly forbidden from committing the department to any spending, any liability at all, if the money hasn't already been properly appropriated through the budget.
Ah, so that's a hard stop. No budget approval, no spending commitment. Full stop.
That's the line in the sand designed to prevent unauthorized spending before it even happens.
Now, shifting focus slightly to those public entities, the ESCOMs, the Transnets, those Schedule 2 and 3 bodies. The person in charge isn't called an accounting officer there, right? It's an accounting authority.
Correct. For public entities, you have an accounting authority or AA. This is usually the board of directors or whatever the controlling body is called.
And is their role different from an AO?
There's overlap, but Section 50 puts a very strong, explicit emphasis on fiduciary duties.
Fiduciary duties, that's a term straight out of company law.
Exactly. It means the board members must act with the absolute utmost care. They have to be honest, act with integrity, and always, always in the best interests of the public entity itself.
So put the entity first before personal gain or political pressure.
That's the legal requirement. And they also have a duty to disclose any material, facts, or risks to the minister responsible for them, the executive authority. It's a high standard of conduct.
This focus on standards naturally leads us to what happens when things go wrong. The Act is very specific about labeling financial failures, isn't it? It's not just mismanagement. You have to use specific terms.
Yes, and understanding these definitions, which are right up front in Section 1, is critical because they dictate the consequences and the reporting. Let's quickly cover the main three.
Go ahead.
First, fruitless and wasteful expenditure. This is money that was spent completely pointlessly, just thrown away, in circumstances where any reasonable person exercising care would have avoided it.
Can you give an example?
Sure. Paying hefty interest and penalties because you didn't pay a supplier on time. Or maybe hiring consultants for a report that nobody ever uses and just sits on a shelf. Money down the drain due to negligence or carelessness.
Okay, got it. Second one.
Irregular expenditure. This one's crucial. It's any spending that happens in contravention of any applicable law or rule. This could be the PFMA itself, Treasury regulations, supply chain management rules.
So buying something without going through the proper tender process, for example.
That's a classic example. If the rules say you need 3 quotes and you only got 1, the spending is irregular. Importantly, the definition explicitly says it's expenditure other than unauthorized expenditure. They're distinct categories.
Right. Which brings us to the third one, unauthorized expenditure.
This is probably the most straightforward. It means one of two things. Either you spent more money that was allocated to your specific budget vote or main division within that vote, simple overspending. Or you spent money on something that wasn't the approved purpose of that vote, spending education money on something completely unrelated, for instance.
And these precise definitions are mandatory for reporting.
Absolutely mandatory. You can't just say, we lost some money. You have to report it under these specific categories. It tells you how the rules were broken.
That precision is vital for accountability. Okay, that sets us up well for Section 3, how budgeting and reporting force transparency and oversight. The budget cycle itself seems key.
It is. It runs on very strict timelines. Section 27 says the national budget must be tabled in Parliament before the start of the financial year it applies to.
And the provinces follow quickly.
Yes, provincial budgets have to be tabled usually within 2 weeks after the national one, unless there's an extension.
No.
And budgets aren't just numbers. They need to include multi-year spending projections. And crucially, AOs have to submit measurable objectives alongside their budget requests.
Measurable objectives. So not just we need X million for roads, but we need X million to build Y kilometers of road to Z standard.
Exactly. It shifts the focus from just inputs, money spent, to outputs and outcomes, what was actually achieved. It's about performance.
The PFMA also seems to tackle that old problem of unfunded mandates, where national government tells provinces to do something new without giving them the money for it.
Yes, Section 35 addresses that. If a new piece of national legislation is going to place a new financial obligation on provinces, say, a new healthcare standard they have to meet the draft law itself must include a projection of what that will cost the provinces.
So no financial surprises dumped on the provinces without warning.
That's the intention. The cost has to be put on the table up front during the legislative process.
Now, arguably the sharpest tool for accountability seems to be the reporting deadlines. They seem incredibly tight.
They are quite demanding. Section 40 is key here. AOs have just 2 months after the financial year ends to prepare the department's financial statements.
2 months? That's fast.
And then the full annual report, including those financial statements after they've been audited by the Auditor General, has to be submitted within 5 months of the year end.
5 months for the whole package.
It ensures the information is relatively current. It prevents failures from being buried for years. It forces a quick reckoning.
And the National Treasury takes all this information from everyone and puts it together.
Yes, under Section 8, they have this mammoth task of preparing consolidated financial statements for the entire national government sphere.
The entire sphere, what does that actually include?
It's huge. All national departments, all the constitutional institutions, all the national public entities, even bodies like the South African Reserve Bank, the Auditor General's office itself, and Parliament. It creates one single overarching financial picture of the national state.
And those reports, especially the departmental annual reports, can't sweep bad news under the rug.
Absolutely not. Section 43 mandates disclosure. The annual report must detail any material financial losses suffered. It must list all the unauthorized, irregular, and fruitless and wasteful expenditure that occurred during the year.
And critically,
It must also report on any disciplinary or criminal steps taken against the officials responsible for that expenditure. The failure has to be logged, categorized, and the response documented publicly.
okay, but with hundreds of different government bodies, departments doing policy, hospitals providing services, museums preserving heritage, huge SOEs running infrastructure, how do you make sure everyone's financial reports are actually comparable, that they're speaking the same financial language?
That's where the Accounting Standards Board, the ASB, comes in, established under Section 87.
What does the ASB do?
It's an independent body, a juristic person, whose sole job under Section 89 is to set the standards of generally recognized accounting practice, known as GAP.
GAP standards?
Yes, and these GAP standards apply to all spheres of government, national, provincial, and even local government, so municipalities too, plus public entities, parliament, provincial legislatures, everyone.
So GAP ensures that when, say, a provincial health department reports on its assets, it's measured and presented in the exact same way as when a national SOE reports on its assets.
Precisely. It creates consistency and comparability. Without common standards, you couldn't meaningfully consolidate or compare financial information across the public sector. GRAP is the foundation for transparent and understandable reporting.
Makes sense. Okay, let's move to our final section, the consequences. The teeth of the act. What happens when these systems fail, when rules are broken, and financial misconduct actually occurs?
Well, Section 81 defines financial misconduct. Broadly, it's when an official willfully or negligently fails to comply with key parts of the PFMA, like the duties of an AO we discussed, or the fiduciary duties of an AA, or if they permit unauthorized, irregular, or fruitless and wasteful expenditure to happen.
And the consequences aren't just internal disciplinary action.
No, while disciplinary processes handle the employment relationship, the PFMA adds another layer: potential criminal charges for the really serious failures. Section 86 is the key one here.
What does Section 86 say? What's the ultimate penalty?
It states that an accounting officer, an accounting authority, or even other officials with responsibility commit an offense if they willfully or in a grossly negligent manner fail to comply with certain core provisions. Things like managing state assets properly, Section 38, preventing unauthorized expenditure, or fulfilling those fiduciary duties, Section 50.
An offense, meaning criminal liability.
Yes, and if convicted, the penalty can be a significant fine or imprisonment for up to 5 years.
5 years, that puts real personal liability on senior officials for financial mismanagement.
It does. It's meant to be a serious deterrent and underscore the gravity of managing public funds.
The system is clearly designed to be robust, but it's also not static, is it? You mentioned amendments earlier. The rules and regulations seem to evolve.
Definitely. Section 76 gives the National Treasury power to make detailed regulations and instructions on all sorts of things: how to recover losses, when assets can be written off, rules for audit committees, and we see changes happening.
Like in procurement.
Exactly. There's a significant amendment linked to the new Public Procurement Act of 2024, which hasn't fully commenced yet, but it signals a big shift. It actually deletes the old PFMA clauses dealing with procurement systems.
Suggesting procurement is moving under its own separate legal roof.
It looks that way, a move towards potentially a single unified procurement framework, taking it out of the PFMA directly. It shows the system is constantly being tweaked and reformed, trying to improve how the state buys goods and services.
So stepping back from all the sections and deadlines for a moment, if you had to summarize the core idea, the philosophy behind the PFMA, what would it be?
I think fundamentally, the PFMA represents this huge ongoing effort to impose the kind of discipline and governance standards you'd expect in the private sector. Think fiduciary duties, independent audits, strict reporting onto the massive, complex, and sometimes politically influenced machinery of the state.
Trying to make government entities act more like well-run corporations.
In a financial management sense, yes. It aims to make state finances predictable, visible, and legally enforceable. It covers everything, even down to specifying the standard interest rate the state charges on debts owed to it, currently 10.50% as of August 2025, according to the footnotes. It's about detailed control.
Transparency and enforceability, as you said.
Those are the guiding principles.
Which brings us to a final thought, something for you, the listener, to chew on. The PFMA clearly mandates accountability, transparency, efficiency, with serious penalties for failure. We see the results every year in reports detailing billions in unauthorized, irregular, and fruitless expenditure. But here's the question. Does the PFMA's success in forcing the reporting of these failures actually mean we're seeing improved financial management overall?
That's the critical question.
Or is it possible that the act is simply very effective at detecting and publicizing the failures without necessarily fixing the underlying systemic issues, the cultural problems, or the capacity constraints that lead to them in the first place? Is it better diagnosis, or is it leading to a cure? Something to think about.